Thank you, everyone, for coming tonight. Just before we kick things off formally, I want to just say a few quick words of introduction. My name is Andrea Dalton, and on behalf of CFA Society Stamford's board, I'd like to welcome you all tonight and to thank all of our panelists for coming. Some of you traveled, even from New York City is considered an inconvenience, so thank you for the effort to get here. And a special thank you to Brian Binkley, our former president of CFA Society Stamford, for making the trip up from Malvern, PA, to join us this evening. Thank you very much, Brian.
Good to be back. Good to be back. Yeah.
As many of you are aware, CFA Society Stamford regularly puts together educational and informative events like this one. And for those of you CFAs who would like to see more of these programs and who are not already members, please consider officially joining, so you'll be right in the flow of the information. And before we get underway, I'd like to also just mention that I'd like to invite you all to join us afterwards back out in the galley bar for another drink and more hors d'oeuvres and more opportunity to chat. So tonight we have the pleasure of Dori Graff here to moderate the discussion. Dori will begin with a few introductory remarks before introducing tonight's panelists to speak. When Dori and I first began discussing potential event topics that would be of great interest to our membership, the OCIO topic quickly rose to the top of the list. And I am so glad that she's here to walk us through this discussion. After years of experience on both the buy side and the sell side, Dori has since spent the last several years consulting to investment firms, all of which has kept her very close to changes and trends in the industry. By any measure, she is one of the most informed and engaged on the dynamics across the investment space. And with that, I would like to hand it off to Dori Graff.
Thank you, Andrea. Okay, I have to have this closer. Can you hear me? Oh, that works. Okay. Thank you. Good evening, everyone. I'm very excited to be here along with this esteemed group of panelists. I do want to thank the CFA Society of Stamford for their support in putting this event together, Andrea and Mark and everyone else. Our panelists have many years of experience covering various aspects of the OCIO space, which we will get into. You can find their full bios on the papers that are on your chairs. Just a few housekeeping items. I have a few prepared questions for the panelists, and then there will be time at the end for Q&A. So please think about all your questions, and we look forward to hearing them at the end of the discussion. And as well as Andrea mentioned, we will be continuing out in the galley after for further cocktails. Very important aspect. So let's jump in. I expect that most of you are familiar with what OCIO is, but for any of you who are not, I'm just going to briefly define it and explain a bit about how this area has evolved. OCIO stands for Outsourced Chief Investment Officer. Investment outsourcing, or CIO outsourcing, occurs when institutions share the discretion of the management of their investment portfolio by selecting a third party to conduct certain functions of the investment process. I say share because while day-to-day management and monitoring of the investments can be outsourced, the plan sponsor can never entirely delegate their oversight responsibilities. So OCIOs can provide a variety of services, including manager monitoring, manager selection, asset liability modeling, investment operations, as well as investment policy design. An outsourcing mandate includes some level of discretionary authority where the provider executes on the recommendations. So this is what distinguishes the relationship from a traditional investment consulting relationship where only advice is provided. Many of the first entities to outsource were endowments and sovereign wealth funds. But today, all types of plan sponsors, large and small, public and private, have made the decision to outsource some or all of their asset pools. Some of the primary reasons that an organization might choose to outsource: a lack of internal investment expertise, concerns over portfolio risk management, concerns over portfolio performance, and as well as a desire to reduce costs. A recent study by Chatham Partners found that plan sponsors that have chosen the OCIO route are most likely to outsource all of their portfolio's assets. To give you an idea, in the survey, 57% of respondents indicated that they outsource all of their assets, while another 15% indicate that they outsource between 75 to 100%. The same study also found that corporate DB plans are more likely than endowments and foundations to outsource 100% of their assets. Smaller funds, which they define as less than $250 million in AUM, are more likely than larger funds to outsource all of their assets. These trends might not be a surprise for some of our panelists, but I think you'll find that as we discuss, you'll start to understand the reasons behind this. As far as market sizing, November 2016 report by Cerulli Associates stated that over the prior 5-year period, discretionary OCIO mandates had more than doubled to $1.3 trillion. And we can only assume that over the last year, that market has grown even further. So as you can see, OCIO presents a great business opportunity for investment consultants and asset managers, but it can also create the potential for conflicts of interest. So I look forward to exploring some of these themes today. And now, without further ado, I'd like to ask each of our panelists to introduce themselves. If you could each share your background and your current role, as well as your firm's activity in the OCIO space. So why don't we start with Roger and move down the line there.
Good evening. I'm Roger Fenningdorf, and I am a founder and partner of Rocaton Investment Advisors. Prior to founding Rocaton, I was the head of manager research for Rogers Casey. And that is a role that I continue to have at Rocaton. Rocaton was formed in 2002. Today we have about 85 clients and $510 billion in assets under advisement. We got into the OCIO business in 2012, so we're kind of late to the party, if you will. But the reason we didn't do it prior to that is because we didn't feel that we had the operational capabilities to do it. So we hired some people, got involved with that, and today we have $10 billion in assets that are discretionary. As I think Dori was describing, discretionary means a lot of different things. So we will do anything from simple rebalancing for clients to up to full discretion, including hiring, firing managers, setting asset allocation, et cetera. So the full gamut of anything that we would normally do on an advisory basis, we just are actually the ones pulling the trigger. We have there's lots of different models, and I think we'll talk a little bit about different models of what people have in terms of approaches to discretionary business. But for us, it's 100% customized. So we don't have product that we're trying to put together and sell through our discretionary channel. Really what we are doing is implementing the same service that we would do on an advisory basis, so it's very bespoke and customized. And how we make decisions is there is a 5-person investment committee, of which I am one, that makes all the decisions for all of our discretionary clients. That is including being an authorized signer to move assets around, to deciding to overweight particular asset classes because we feel that there's a compelling opportunity. And I think I'll leave it at that.
I'm Susan Webb, and I'm the founder, president, and CIO of Appomatox Advisory. My background was structuring and trading and running derivative desks on Wall Street, and then I joined a fund-to-fund and started allocating portfolios and selecting hedge fund managers. What I learned in doing that is that was really not the way to approach helping a client out that had a portfolio, that you really need to have a better understanding for their overall needs and what the purposes of the investments were for and what kind of liquidity they needed. So I set up my business in 2005, and we began customizing portfolios for clients, and that evolved into the OCIO, which people now label as that. But for us, it was getting clients closer to their money and getting them a lot more understanding of what was happening and addressing their cash needs. So everything we do is bespoke, and we never sell them a product that we create, so there is no conflict of interest. We think it's just easier that way. We have a second skill set that has given us carve-outs from big state pension funds and smaller endowments, and that is that we're very good at selecting emerging hedge fund managers. And under that niche, we also allocate as the OCIO, but for a portfolio of emerging managers. We're about $2 billion now. We have 28 clients, and we just recently won a large, well, for us, a large university endowment, so we're excited about that.
Good evening, everyone. So my name is Brian Binkley, and I'm with Vanguard in their outsourced CIO business. Prior to joining Vanguard 5 months ago, I was with Aon Hewitt in their investment consulting practice. And there I worked on what you call the traditional consulting model, where we provided advice, but we did not have discretion. However, with that said, the OCIO business, even within Aon Hewitt, has been growing rapidly. So talking about Dori's points on assets, you know, how the industry has grown and basically doubled in the last 5 years, that's been the case for Vanguard as well. So we've basically doubled our assets under management in the OCIO space, which is full discretion, to approaching now 40 billion. And we've been doing that for 20 years. I certainly haven't been there, but Vanguard has been doing this for 20 years, but have just been seen and taken advantage of the big growth in the industry. And we could talk about some of all of those trends. As far as our business model, you know, Vanguard is known for passive, of course, but we are agnostic. We are one of the largest sub-advisors of active managers. So with over 600 billion in active strategies. So we are agnostic to passive or active. We just believe in low cost. We do use only Vanguard funds at this point, and we could kind of talk about, you know, those potential conflicts and ways we try to mitigate that with our clients. So I'd kind of just leave it there as far as, you know, just background on myself and the industry, and then we'll get into more details.
Thanks for that. Hi, I'm Chris Cutler, and I co-manage a joint venture between my consulting firm, Manager Analysis Services, and Russ Mason's firm, Investment Management Institute. And this joint venture is consulting for endowments, foundations, and families in the search and selection of OCIO firms. And just to give a little background on that, my consulting firm has been specifically focused on helping institutional investors conduct bespoke due diligence on hedge funds, private equity managers, and individual venture-backed firms. We've never had an interest in acting as a consultant to run an entire portfolio, and no way are we ever a competitor for any major consulting firm in that role. It's very specifically being the artist in the finance industry, just doing the best analysis you can on individual investment strategies and opportunities. Russ Mason, who's also sitting here in the front row here, is is an expert at financial education. He runs Investment Management Institute, something he's been running for about 30 years. He was also the head of a CFA Institute's predecessor organization for education programs. He has tremendous credibility in front of the institutional consulting firms. So what we've done is we've teamed up to provide a service to institutional investors to conduct due diligence and help them select the right OCIO firm for them. We are not believers that we're going to have our 3 favorite OCIO firms. There's such a disparity and difference among OCIO firms in terms of what their skills are, as well as investors and clients. And finding that proper match is a very difficult and rigorous exercise that we conduct on behalf of our clients. We've been quite busy. We're working on a number of mandates now, and we try to get involved with the clients before the OCIO search stage. What we really want to do is we want to get involved with the clients at the governance stage. What are their objectives? Do they want to run the money in-house? Do they want to go to an OCIO firm? Why? What's the proper match for them? And help them with those issues. And then when we truly understand the client, can we help them with the OCIO search? So that's enough on that, and I'll leave it there. Thank you.
Well, so I just want to first talk about the current state and of the OCIO space and how we got here. So, Brian, given your experience having worked at a consulting firm and now at an asset manager focusing on the OCIO product, can you talk about how the industry has changed over the last decade or so and grown, and what do you think are some of the key drivers for that?
So I would say one of the biggest, trend, well, how's it grown, is I think that there's just been much more players coming in. There used to be, some smaller boutique firms that only did OCIO, a common fund, or Hurdle Callahan, but now I see really everyone is in that space. If you're an asset manager, if you're an investment consultant, investment manager, you're still the boutiques. So everyone is getting into that space. One, I think, say from where I was at a traditional consultant, the margins are better, so it's a different revenue source for consulting firms. And then just as far as the trends that are taking it there, is we say it's really, time, willingness, and ability, right? So more just there's a trend towards advice, whether that's an individual outsourcing it to a financial planner and fee-based, and now it's institutions. So for so many of these firms, they just don't have the time to get dedicated to it. They're doing another role. They're a CFO, they're a treasurer. They don't have the willingness or the ability just to keep up with the timing of the market. I'd say that there's other reasons around governance. And then lastly, I would say even continuity. You see staffs at endowments and foundations or pension plans turning over every 2 or 3 years. And so sometimes the consultant, the OCIO provider, has been there for 10 years, and they have the history, and the actual client doesn't. So I think those are all different trends that are pushing the industry to continue to outsource.
Great. Roger, can you talk a little bit about the decision process that Rocaton went through to start your OCIO business? Was it client-driven? Was it company-driven? And then you can maybe talk about how you avoid that conflict between the discretionary and the non-discretionary clients.
That's a lot of questions. So we got into the business because we really started to recognize that some of our, in this case, some of our smaller clients were actually making the decision to take their assets and go to an outsourced provider. And I know it might have been Vanguard. I'm not sure who it was. And so we came to the realization that we didn't want to lose. I mean, because let's face it, in any industry, any business, you don't want to lose clients that have been good clients who have been very happy with your services for a very long time, and they just really didn't want to be on the hook for making decisions anymore. And so when they had a solution, whether it's Vanguard or somebody else, they had a solution that they can go to that solved all their problems and they could focus on other things. And we said, well, this is kind of silly because these are clients that are happy with us, that are leaving for reasons that we think we could actually implement. And so we started to say, okay, what do we need to do to build a business? And so, as I referenced before, it was hiring some operations people to basically get our policies and procedures in place. We felt like we had all the necessary components in place other than the operations aspects. So we had, what we think to be very strong asset allocation and capital markets work. We have very strong manager research capabilities. We thought we had very strong insights on, being able to be in markets based on valuation and all those types of considerations. So it was basically making sure we got the operations part right, because that's maybe not the most glamorous part of OCIO, but it's also the part where you can really screw things up badly. So once we got all that in place, then we said, okay, let's go ahead and do this. And fortunately, we had a client who we were doing a project on, basically evaluating their OCIO provider, and we were trying to advise them to get into more alternative products, really more illiquid stuff, because they didn't have any of it. And they said, well, if you can do all this illiquid stuff and you can be helpful to that, why can't you just do the whole thing? And we're like, yes, we can. So that really started us off, and it was that's been great, and it's grown since then. And what was there was another? I think that was part one.
The conflict.
Oh, I forgot that part.
Yeah.
So look, there are certainly lots of ways to have conflict in what we do. I think the way we really and I'll describe a couple of them. Vanguard will have specific conflicts. We'll have specific conflicts because what we do is both advisory and discretionary. So people will always ask us, how do you manage what you do from an advisory standpoint versus discretion? And so I think the thing that we have to focus on is making sure is that whatever advice that we're giving to our broad client base. One of our clients happens to be what we do on a discretionary basis. So anything that we do is broadcast to our entire firm that is communicated to all of our clients, and then we will talk about that particular topic within our investment committee, whether it's appropriate for our discretionary. The benefit is that we can act fairly quickly, because if we think it's a really interesting idea, we don't have to go through the whole education process that we do on the advisory side. And sometimes it's very frustrating because you have a great opportunity. We want to execute, and it doesn't happen. So I think making sure that all advice and all clients are treated equally. I think that's one of the CFA Code of Ethics. Do I get a check?
Pretty share rule.
Yeah. And then the other areas is trade allocations, right? So if you have a limited amount of assets, we advise $500 billion in assets, so if there's a limited opportunity, how do you handle that? So we have a trade allocation process in place. That's an important thing. We don't have product, so that is one aspect. We can kind of check that one off the box, that there's not, and I'm sure you can talk about some of the aspects of that. And for us, it's really just an extension of the advisory services that we've always done, but now we actually can pull the trigger. And in some cases, that's really very advantageous when there's a lot of governance issues that some clients have, and we're able to take advantage of our ability to move quickly to rebalance. There's so many clients, just simple rebalancing that doesn't happen because they're too busy doing other things. And if you look at, everybody's studied rebalancing. That's a great way to lose a lot of money if you're not actually followed a pretty strict rebalancing policy.
And institutional investors make the same mistakes as individuals, right?
Oh yeah, absolutely. I do it all the time.
As far as letting it run, it's going to keep running, and we don't need to rebalance. And so I've seen the institutional investors make the same mistakes that retail investors supposedly only make. There's some incredibly large clients.
I shut that off, I think.
Yeah.
No, that's still on. I just tried to cut the feedback. I hope it worked.
So there's some very large clients that just cannot get things done. And so I think there's a number of clients, and I think you were talking about how it's the whole governance aspect, and I think that's really critical. And people need to recognize that they really need outsourced CIO services because they're just losing a lot of money. Some clients, you know what, it's not appropriate for them because, you know, they have very good staffs, they have a good governance process, and they move quickly, and you know what, they probably don't benefit from it as much as somebody who doesn't have a good governance process. So I think that's really kind of critical to the whole thing.
Well, I think that raises another question, which is kind of like, well, what's the background of the OCIO industry? And it's the investment universe has gotten increasingly complex. You know, 20 years ago, it was stocks and bonds, and people will look at, well, stocks aren't just stocks. There's growth, and there's value, and then there's large cap, and there's small cap, and there's international, et cetera, right? And they would parse it all those ways, but to us it looks pretty simple today compared to what we have now, which is we've got private equity, we have hedge funds, we have real estate, we have, you know, venture capital, we've got emerging markets, we have agriculture, and the list goes on. And the investment world got very complex. So I think, you know, institutions would say, well, yeah, it's getting complex, but we've got a really good staff, and our staff is very talented, and we're, even though we don't necessarily understand as well as we would like, I'm sure they wouldn't say it that way, but we're okay because we have a great CIO and a great staff. Well, I think what's happened in the last 4 years is that those great CIOs and great staff are great, but the investment universe changed radically, and some of those brilliant ideas didn't work too well, particularly in hedge funds and in some other areas. And yields are also very low, so people are finding the returns lacking, and I think there's been a crisis of confidence to some degree in that model of having the great CIO. And so if, on the one hand, you have this question about investment performance, and then on the other hand, you have these other nagging questions out there, which is, hey, you know, my institution's focused on education. My institution's focused on a charity. What do I know about hiring people and providing human resources for people in finance? And it's a very hard area to cover. So these are governance issues. How do I know my staff is doing well, and how do I pay them appropriately? And if I do have to change them, how do I find somebody to change them? So these are tough questions to ask. And I think what we've seen, and we've seen a wave of organizations, and we're in no way saying that this is the right thing for them to do or not to have done, but we've seen a wave of organizations, particularly on the smaller side, say, look, I can't handle these questions. I like these consultants in general, and I want to give them more authority to run my portfolios because my in-house CIO teams are not adding the value I would have liked. And so there's been more willingness to go to an OCIO model in the last 3 or 4 years, and the growth rates in the business are something like 15 or 20% per annum in AUM growth. And you quoted the number, Dori, of like 1.3 trillion. And that's very interesting. So we've seen that way, but we've also kind of seen that there's a cutoff. It's not a strict cutoff about the benefits of having an OCIO versus having in-house staff. And we've actually seen a client, not in this actually not our client, but we've seen an organization go from OCIO to hiring in-house staff. So we're starting to see dynamism going both ways about the OCIO model as time progresses. So there are a lot of dynamics with regard to, you know, where this industry is going, but it's kind of tough to say, you know, that you've got a $100 million endowment, you're going to do a good job with in-house staff. It's a very tough thing to do, and it makes a lot of sense to get a larger OCIO firm involved, meaning, you know, more than a staff of 2 or 4, to give you best-in-class performance, similar to what Yale or Harvard or another large organization might get, because that's what the OCIO firms are capable of providing to a small institution.
Harvard hasn't done so well, right?
Yes, exactly. And why haven't they done so well? Because they pursued a lot of these hedge fund-like strategies using in-house traders, and that's a whole. I'll spend 2 minutes on that, and I promise I'll stop. Which is that there's a fundamental change in the way markets trade that has completely evolved in the last couple of years, and ways that hedge funds used to make money are, in many cases, not really working so well. And so the whole hedge fund sector sector is really seeing a compression of alpha of their returns. Yes, this year is looking better, but guess what? Beta is also doing a lot better as well. So if a lot of talent is focused on the hedge fund area and people have done their best efforts to do well there, it just doesn't look good because they've been fighting, they've been pushing against the wind on that one. So that's a bit of a problem for Harvard in the case that you articulated. And
I would say with Harvard's case, they could have kept the CIO longer than 2 years. I think the constant turnover of the CIO is what cost them, and the fighting on the board because everybody has their best idea, and you really need a CIO to be independent, which is something that I've seen you gain a lot when you outsource a CIO. You separate the investment committee, who always has the best intentions, right? They want to do the right thing for their school, for their endowment, for their foundation, but they also have a small little fund over here that they know, or they're paid by somebody for marketing this fund. And somebody has to be the person that independently says, no, we're going to have the right structure in place so that we don't have that conflict. And I've talked to a number of the top CIOs at these endowments, and across the board, the best ones are saying, if there's anybody marketing a fund on the committee or on the trustees group, we're not investing. If there's somebody who is running a fund, we're not investing. So the best place is put in that kind of a governance stuff, and that eliminates conflicts, because the last thing you want to do is to hesitate when you're deciding to get out of a manager. And just a slight hesitation, whether it's because you helped to seed that manager or because some other kind of a conflict, I think does affect returns. And in a market where GMO is predicting the only thing that's going to make money going forward the next 7 years is in emerging market equities, then you really need to focus on all these fees and what's happening there and what are the conflicts involved. And you really have to have the best interest and the fiduciary responsibility for the foundation first, or the endowment first. And therefore, I feel very strongly conflicts should be eliminated.
That's a great point, Susan. And I would say, it's if you think about hiring an OCIO from the fiduciary perspective and the conflicts, obviously this isn't like going to the Elks Club or the local Masonic Lodge, and nothing against those institutions, but you're running money for thousands of beneficiaries or for endowment or foundation. It should be done professionally, and it's a life-changing decision. If you think about it, you're essentially hiring one manager with fiduciary authority over your entire endowment or foundation or pension plan or whatever your organization is, and you better get it right. And so when I hear these stories that Susan's just sharing, and we've all heard them, about these informal ways people on the board just use their little local network to figure out who the right OCIO firm is, I think it's just a huge risk of fiduciary liability, and that's why we strongly believe people should really have a proper search to try to find the right match between the OCIO firm and what the institution is. And this kind of ad hoc decision making is a very dangerous thing for the institutions and for their board members.
Can you talk a little bit more about how an institution might determine which provider they would hire in your experience?
Well, sure. I mean, and everyone else will have their own experiences, and I welcome you all to share them. One of them is just understanding, what their cash flow needs will be going forward, and trying to match that pretty simply with what the OCIO manager's strengths are. Some OCIO managers are very good with some strategies and others, and liquidity profile is very important. There are some institutions I've seen where the liquidity is actually quite challenged over the next 10 years, and it's very hard for them to invest with private equity. Yet they've been pitched by some OCIO firms that really focus very heavily on private equity and things like that. And so that's kind of a bit of a challenge. There are other cases where I'm sure Susan, Drianna has known a lot about institutions that focus on ESG investing and things like that, and firms such as yours are very strong in that area, and that's a proper match, I think, for potentially for institutions that really care about ESG ESG and UNPRI kinds of mandates. What I see, and then there are other institutions that care very much about client coverage in terms of explaining and understanding what's going on with the underlying portfolio, and others where they don't really care a lot. So there's a broad range of the needs of the investors that have to do with their risk profile, the ESG profile, the return profile, the liquidity profile, and the communications and coverage on behalf of the manager. So I'll just leave it at those for now. And correspondingly, on the OCIO side, there are varying strengths of these different institutions. So finding these multi-dimensional matches is a bit of a challenge, but that's the kind of thing that we focus on.
Great.
I would just add, the most recent mandate we won, one of the deciding factors for us is the investment committee was really a phenomenal committee. There were 4 or 5 people that ran their own quite large credit and fixed income hedge funds. And one of the things that they had not been getting from their consultants was any kind of real risk assessment of the portfolio or the underlying risk, and what were the risk factors, and this awareness of where the markets were going and how do you factor that into your allocation. And there was no real understanding of markets. So they were really looking for someone that had a lot more granularity into position detail and was assessing a portfolio on a variety of metrics. So they looked at, risk factors, liquidity, and all sorts of ways of assessing whether you could accomplish the task for them. So, if you get a good committee and they want to be involved, they also want to see reports that are useful to them.
Let's shift gears a little bit. I'd like to talk about fees a little bit, and to understand how fees are set by the OCIO providers and how they might differ for those of you that have the non-discretionary businesses. So I don't know, Roger, if you want to start.
Yeah, sure. For the most part, our advisory business is flat fee retainer business, and on the discretionary side, it's mostly asset-based. I think there is generally a premium associated with discretionary. I think that makes sense. We're taking on more risk and more liability, and we're making more decisions on behalf of our clients. I would say there is the delta between advisory and discretionary will go up as the complexity goes up. So we have a fee schedule that we use with alternatives, and we have a fee schedule that's without alternatives. And because there's a lot of, as I'm sure everybody knows, there's a lot of paperwork that goes involved in a lot of legal document review that we take on when we are doing a discretionary for with alternatives. I'd say so. That's one end of the spectrum, and then if you get to the other end of the spectrum, one of the surprising things that we have found with our discretionary business is that we've actually been picking up a lot of defined contribution plans because people don't necessarily want to be in the business of monitoring, their managers. They don't want to be in the business of making the hire and fire decisions for their managers. And then once we work with them to set up the investment structure, they really don't want to do much else. And then so they'll use their record keeper to do the participant communications and the administration of it, and then everything else that we will get involved in. And if you think about it at that end, there really isn't as much of a delta in the fee that you would be charging, because for us to take on a lot of small DC business, that would be low margin business for us, because we'd have to cover all the managers and do all the communication and all the customized work that we do for those smaller clients. But for discretionary, we have a model, if you will, that we will use for what an investment structure should look like, and we have preferred providers that we will use for the small cap option or the large cap option or whatever the case may be. There will be providers that we will typically use. They may change over time, but there will be a lot of similarity across a lot of smaller clients. So in that case, there really might not be much of a difference at all between advisory and discretionary, because the more that we can leverage those types of relationships, I don't want to say it's cookie cutter, because it's not, but it's much, they rhyme a lot more, and margins will be better for us.
Yeah, I would just say that as far as fee structure, similar for us is if for taking discretionary, it's usually an asset. It is an asset-based fee. It's a sliding scale based on the amount of assets that you have. Coming from my traditional consulting, yes, it was a flat fee. Just in speaking to the fees and talking about the conflicts of interest, since it came up before. So, for instance, we'll charge an advisory fee for the discretionary services. I mentioned earlier that we use only Vanguard fees, but at least with our pension clients, to avoid that conflict of interest, it's a ERISA rule, but we'll provide a fee offset for any of those Vanguard funds that they're in. So we'll quote a gross fee so they have the full transparency, but then we'll provide an offset for going into a particular Vanguard fund to eliminate that conflict of interest. So we try to be very transparent on fees. You obviously get that permission. They have to sign off on understanding that arrangement, but it's pretty straightforward.
Susan, do you have anything to add about how you've approached it?
Everything we have now is discretion. So.
Okay. So that's pretty straightforward.
I will say that we have some MFN language for emerging manager mandates, so we don't go below that fee for anyone else that hires us, and those particular mandates, you do get paid more for those because it's a lot more work.
The emerging manager. Mm-hmm. Brian, just based on the fact that Vanguard works only with the in-house products, and do you find or do you believe that the Vanguard model is primarily for smaller plans, or do you feel that larger ones also benefit?
So that's what it's been historically. As far as the sweet spot has been that 250 million and less, but much more centered, even smaller than that. And I think we talked about that's where a lot of the growth has been. But with that being said, and where we've seen growth is we're seeing more growth is between 250 million to roughly $1 billion. We do have a couple of clients over $1 billion, but those are the outliers. I think you were alluding to that, Chris. So as the outsourcing trend is taking grip and more providers are talking to asset managers about that, I don't see why you couldn't scale, and more firms doing 250 million to $1 billion don't see the same advantages that smaller plans do. So I think the growth will, it started small, but I think there'll be more and more bigger plans adapting that.
Okay. Shifting gears again, I wanted to talk about constructing the portfolios. Susan, could you talk about how you approach constructing client portfolios, and how do you measure success in this solutions-focused environment?
We spend a lot of time first on the IPS, so that we can make sure we're all on the same page on what kind of return and spend rate that they need, and understanding the timing of some of the needs of the endowment or foundation or individual. So first we set that up, and we come to an agreement as to the risk and the drawdown risk, and then we allocate across what we consider to be the major asset allocations, and asset classes, and we allocate by return drivers rather than by specific equity or bond. And for us, return drivers fall into the categories of both equity and credit rather than fixed income, and then we span a spectrum of opportunistic between the two, and we have a third category called diversifying that is decorrelated from both equity and credit, which is a very difficult category to solve for, but we try our best.
And so as far as performance measurement, do you set a particular benchmark, or do you?
Yeah, we always have, a lot of funds want CPI plus 500, a lot of endowments. Our most recent one has a target of 8%, so it's a very aggressive target. Yeah, well, they need it, so. But fortunately, they also have a high tolerance for illiquidity. So the two match, actually. And I think we'll be able to achieve that return for them. We have been, over time, compounding at over 8% with our portfolios, so that's okay. I mean, we get hired to deliver absolute return. We just need to tell them what parameters we need to meet that return. and they may or may not decide to hire us given those parameters.
Roger, do you have any comments as well on the structuring and how you approach that with your clients?
Yeah, it's really, I mean, so for our defined benefit plans, I mean, it's really structured around what the liability is, and so that's really the whole asset allocation exercise is based on, you know, what's important to the client in terms of what their risk tolerance is related to the liabilities, and then everything else kind of falls off after that. For defined contribution, that's pretty straightforward. You know, you build an investment structure that you make sense for the population of or the participant base of the client, and then you try to build something that's robust and helps avoid some of the behavioral finance issues around participants. So that's a big part of what we try to communicate and build in that area. And then, you know, other areas that we focus on, we don't have a whole ton of clients in the endowment space. We do have some. Again, you know, I would just echo what Susan said. I mean, that's really the focus is. And then lastly, wealth management. That's again, we have a fairly significant part of our business is in wealth management, and that again is, you know, there's a number of different considerations that go on with that, taxes being one, and so that's fine.
Yes, as far as measuring performance, it's simply, you know, the policy benchmarks. So as Roger mentioned, it's different for DB plans, which is focused on the liability, versus the endowment foundations. So it's structured really your policy benchmark that you're setting up, and Susan talked about the biggest part is setting up that investment policy statement correctly. As far as you're asking about, you know, building the portfolio, some CFA stuff, you know, we all know those studies, right? 90% of the results are usually from asset allocation. So we spend most of our time there. We're not tactical in that sense. So we focus, we know the markets can be, you know, cyclical. We don't know when that's going to happen. As far as our business model, we're not trying to time the market, and we're being broad and diversified. So that's mainly how we're building it, and just leaving out some of the details. But
I'll just add that all these responses are so professional, so I have another perspective, which is the don't embarrass me index, right? I mean, don't give me an allocation that where my portfolio does significantly worse than everybody else's of a similar size institution. And that can be categorized in a number of ways, and there's a number of common indices out there, and it's kind of unfortunate because there are risks that institutions should take to diversify their returns into other asset classes and strategies, particularly where they have OCIO firms or consultants with particular strengths in different areas. But sometimes they're reluctant to move in that direction, I've seen, because they are concerned about doing something that's materially different enough that would cause their returns to deviate from what they consider their peer group.
Great. So, Chris, want to get a little bit specific here. When we spoke before, want to focus on the risk side of outsourcing, and you have a unique perspective working with the different clients who are outsourcing and kind of comparing the different providers. One of the things that you mentioned was this clause around private investments and what happens with these illiquid products if you change OCIO managers, and how have you sort of seen, can you explain that a little bit if people aren't familiar with how that issue might arise?
Sure. I mean, there's a legitimate, case that OCIO providers or any other kind of institution may make about the effort they have to put into conducting due diligence and understanding the hedge fund and particularly private equity managers in order to advise clients to get into an investment that lasts 10 to 15 years. That much of that work is upfront. There's ongoing monitoring, of course, and there's things like that, but much of the work is upfront. So the argument is that if an institution makes an investment in private equity upon the advice of an OCIO firm, that they should continue to pay fees on that investment even after they fire the OCIO firm. And so, Well, it's actually not uncommon, and what it is it's an investment in a pooled vehicle. It's kind of like an in-house fund of funds at OCIO firms, not all of them, just some of them, and they would continue to be in that OCIO firm's fund of funds of private equity funds until the investments are paid out. And then the question is, well, what should the fee structure be on that? What's kind of fair? And our approach is, we want to be completely transparent and understand what all the terms are, and make a intelligent investment about that, with regard to what the client is and what the risks they're taking on, and make sure that those fees are fair. And there's no clear answer exactly what fair is in those cases. Certainly, OCIO firms charge, as some of the people on the panel have pointed out, they charge more in terms of OCIO fees if the investment involves alternatives. So, kind of, there's a trade-off between those two, and so this is kind of an area where there's no black and white rule. It's kind of gray, because you have to kind of weigh what the fee schedules are of the OCIO firms when the actual competition is to get the business, against what the tail end terms are. But there's a lot of other tricks to this business, and I'll tell you, I think one of the biggest opportunities in OCIO that is just starting is going after the private bankers business, because that's where a lot of the tricky fee things occur. So I'll just leave it at that.
One of the things that we've actually dealt with is when we've picked up business from other OCIO providers is exactly what Chris is talking about. And the way that we've handled it is we continue to report on those private equity investments, but we don't consider that part of our purview. So if it's a private equity investment and say they have make up numbers, but 5% is tied up in this legacy, and we think that there should be another 5%. We'll just add what we think is the appropriate 5% to complement what they already have, but consider the legacy stuff off the table, and don't consider that as part of our fees, because it's, we didn't put them in there, and, maybe we like it, maybe we don't like it.
I would just add that we always go in and do our own due diligence as soon as we get hired, on private equity. And right now, secondaries are quite liquid. You can get out if you don't like something, just a 5% discount. So, 5 to 10, that's where it's trading. You'd be surprised. So I think you still, even if you're not, and we haven't ever figured out this thing about getting paid for it. They never pay us for that. We're always, trying to do what works for the client's portfolio. So we don't get paid when we inherit that stuff.
Right. No.
Do you get?
No, we didn't get paid for that. No.
No. Similar, we'll factor it in, and a lot of our clients come to us when they've implemented alternatives programs or tried a latest fad and it didn't work out, and they've been unhappy with the performance. And so there have been those instances where they're still in a 10-year commitment or so with private equity. That's separate. We'll take that into consideration, but we're certainly not collecting fees on those assets since we're not managing them.
But you still, suppose you inherited a portfolio, sorry, I'm just interested, where it's a 10% current allocation to private equity, and in your asset allocation you only want 12, then you're not really going to add your 12 on top of that 10, right? You still consider that in the asset allocation, or do you separate that out and then reallocate what's left, the 12% private equity that you want?
Well, in our case, it's easy. We don't allocate to alternatives, so it's easy for us.
We consider part of the.
You still consider that they have that.
Yeah, absolutely, because we wouldn't double it. It's part of their portfolio.
Bring down your return if it's not very good private equity for a while.
Right. Well, yes, but I think similarly we would do something and go in and look at it like you guys would. Yeah.
Well, this brings up an interesting point, which is something I mentioned earlier about when the partial versus total outsourcing. So I imagine that this type of issue with allocation might, if you don't have a whole portfolio from someone, would even be a bigger concern or more challenging to figure out. I'm curious if you guys have worked at all with these just a partial mandate from a client, and how do you handle that, or do you prefer to just have the whole thing? Well, obviously, prefer to have the whole thing, but
yeah, we'd prefer to have the whole
less
thing.
fees is better.
Yeah.
We in our advisory business, we've worked with lots of clients, and we've worked with multiple consultants with clients. So, we'll be hired to do traditional, and somebody will hire Townsend, or somebody will hire name your specialty private equity. So that's fine. We've worked with under those circumstances for many years. Sometimes we have the whole thing, sometimes not. With OCIO, we have had. I would say it's less common. I would say for us to. They would have multiple OCIO. So I think we will certainly have discretion on a piece of the portfolio, and then advisory would be the rest. So in the case of alternatives, I think we would put together and make the selections for a particular client because they just don't feel like they have any expertise. But I think that would be part of an advisory relationship as opposed to something completely separate.
I mean, I think a big conflict is going to start emerging if you get a carve out for alternatives, right? You may have putting in some hedge fund managers, some private credit guys that you're going to have also covered in fixed income or in real assets or in some private equity that they're defining as private credit too. So you may see too much of a similar type investment because so many people are moving into private credit and they're kind of hiding it in what they're doing and saying it's something else. So I do see that being a concern, and we make sure we communicate, look, we're doing this, you make sure you don't have it somewhere else in a similar space. I think that could be a issue that crops up.
Okay. Well, just one final question here before we open it up to questions. Looking forward, we've talked about what has driven the growth of OCIO and the situation today. Where do you see this going? Do you think that the growth will continue, and why? I don't know. Do you want to start, Chris?
I think it will continue to grow, and I think it's kind of a natural evolution where organizations that were comfortable working with in-house staff and consultants will continue to move toward the idea of giving the consultants more and more discretionary authority. We're continuing to see that trend grow, and that's taking up a larger and larger share of the smaller institutions, particularly under $1 billion, but even the $1 to $5 billion range. But still, at the larger institutions, we're seeing a lot of interest in having in-house staff and in-house resources, and there's a trade-off between the two that varies a lot depending on the issues about management of financial staff in a non-financial institution, and alongside that, the competitiveness of the OCIO firm's fees relative to the cost of having in-house staff. So we're seeing a lot of fluidity in those dynamics occurring over time. We've seen OCIO fees drop substantially in the last 2 years, although there's still a multiple, for example, 3 or more compared to consulting fees. And as that fee drops, and that sort of implicit cutoff line in assets for institution to go to OCIO versus in-house staff continues to grow. So we'll kind of have to see how that plays out. There's certainly benefit to having in-house staff, and I think there's as I said, we've seen some cases of at least one case of it going from OCIO to in-house staff, not necessarily even using consultants. So I'm encouraged to see that sort of dynamism, and I'm encouraged to see more attention to the governance process of institutions to determine how they should run their assets. So I'll leave it at that, and we'll return to later questions.
That quickly is any of the reasons why outsourcing has been happening now are not going away. So what we talked about, governance or cost benefits you can get for outsourcing or complexity in the markets with the asset classes, all of those aren't going away. So therefore, we did see the outsourcing trend. We're seeing it continue. As I mentioned before, we're seeing it with larger organizations. And then as Roger pointed out, it's also going to DC plans. That's behind pensions, endowments, and foundations. But it is going, I think, to continue to shift even to the 401k, the DC side, also because of complexity, governance, cost. So I would say advice is going to continue to grow at the individual level, the institutional level, and even in the DC space.
Yeah, I think, we've had this nice beta run, and as soon as that starts to abate, we think we'll probably be in a year and a half or so, people will realize they do actually need an active CIO managing their money, and that's why I think this space will continue to grow, because the niche and the ability to get access to good alpha-generating ideas is just shrinking.
So I'd say 3 or 4 years ago, we used to have maybe 1 in 10 RFPs would ask about discretionary. Today, I think that's about 75% of RFPs that we get ask about our discretionary services. So I think that is kind of telling on where things are and where they're likely to go.
Great. Well, I'd like to open it up for questions. There's a mic floating around, so please wait for it. Thank you.
Yeah, sorry about that. I don't need this out loud. So I got a question, I guess, for Chris, really. I mean, each one of these models makes sense, right? And Susan, I think you talked about how a lot of these portfolios are bespoke. So, you know, the traditional way is you're going to look at managers based on returns and risk and things. How do you sort of compare? Is it cases, like they'll provide you, this is an endowment, this is the portfolio that we built? You're not looking at monthly performance over time, right? So how do you sort of compare?
Really? You don't look at just monthly performance? No, just kidding around. That's sort of like the joke about looking at hedge fund investments is that you just look at monthly returns and you run some regressions. So it's obviously a lot more complex than that, right? I mean, what ultimately we're trying to build is a model of how you think that OCIO firm will do for your particular client in the future, and a lot of that's qualitative. Yes, historical returns are important. How the OCIO firm did compared to what they considered their own sort of benchmarks, whether those be actual, you know, quantitative benchmarks or some other metric, are important indicators potentially of success. But if somebody, particularly over the last few years, didn't hit those benchmarks, it's important to understand why they didn't hit those benchmarks too, because it has been a very unusual period of time, particularly for investing with hedge funds. And so that's not necessarily, in my eyes, a future predictor of performance with regard to them. So I think, you know, it's important to understand, first of all, what the needs are of the client and what they're willing to do. So there are a lot of criteria about that, but a lot of the things that I would consider have to do with liquidity and risk appetite. Okay, so if the liquidity profile is that they don't really need a lot of liquidity, that gives more flexibility, and the risk appetite's higher, that allows for, you know, different kinds of things, and that sort of suggests different kinds of OCIO firms to be involved with the process. And, you know, some clients also strive for complexity or simplicity, right? And if they're really striving for simplicity, they want liquid product, they want transparency, and they want to really understand what they're doing. And this gentleman here's got the perfect thing for them, right? Right? And that in no way is meant as a criticism. There are a lot of virtues for it. So you can kind of see that there's a lot of different things at play. You know, there's also sort of governance issues with regard to the investment, you know, institution, of how stable the board is, how much they're behind it, what's the turnover on the board like? Is the next board going to come in 2 years' time and start questioning and, you know, everything that's already been done? And that kind of suggests a different kind of OCIO sort of relationship. So I would say there's, you know, the roadmap for what we do, or what Russ and I do and our colleagues do, is a very complex one, and there's no real silver bullet that really explains what the right way is to do. And the last thing we'll do is we'll never say we've got our 3 favorite OCIO firms. You know, it's multidimensional both on the investor side and on the OCIO side.
I would also add, look, a lot of it is, I don't know what, you guys are working with much larger clients than we do, but our average client now is around 200 million, and they really want to still have us come in and talk to them. They want to know who is working on their accounts, and they want a very high touch approach. So what we can do is quite limited, because you only have so much time really to go to these quarterly meetings and to meet with the investment committee and to be responsive to your client. Therefore, you know, the size of our firm is going to be substantially smaller than either of these two, because that's the type of client that hires us, that's someone that really wants to be still looking at it and talking to us, and still somewhat a real active fiduciary in managing the money for the endowment of the foundation. So a lot of who you pick is going to be the match between that organization and the outsourced CIO. I think that's very important.
Yeah, I'll just add that it is qualitative, right? Think about hiring an investment manager. Of course, you can look at their performance against, a small cap manager, but you're going to evaluate the firm and the philosophy and the people. And I recently had a CFO come to me from a fairly large foundation we're bidding on, and they said, you and 3 other firms are in here talking about your asset allocation process. Frankly, we can't tell the difference between one versus the other. And so they did ask questions. How often are you going to see us? What are we not going to get? Reporting. So they did focus on a lot, of course, cost. They did focus on a lot of the qualitative aspects because, again, since it's not their day job, they didn't understand the difference between our asset allocation model and the competitors.
Thank you for doing this. My questions are more trying to understand the OCIO model, so forgive me if they sound very basic. I'm sure they are. If you inherit a position, let's say private equity, but you also have that position or that firm elsewhere on your OCI model, are you now charging for that, or do you still hold that as kind of non-fee paying because you didn't do any of the front end legwork, but you're still obviously invested elsewhere? So that's one question. Another question is on your advisory, a few of you talked about different fee schedules. So on your alternative discretionary fee schedule, do you charge a performance fee in the OCI model in that for alternatives? Is it kind of like a fund of funds that you tack on in effect to a long-only kind of discretionary OCI model? And then third is there was discussion about the governance and managing the conflict between getting into a position, let's say a 10-year private equity. Tell me how you manage kind of the conflict in getting out of that position when you have discretionary and advisory clients, and how that all works. And those clients, both discretionary and advisory, are invested in that private equity, and you can go sell it to some secondary investor, some fund out there for a 5% discount, which obviously speaks, I think, a lot about the market, I guess. But so basic questions, but I'd be curious just kind of in your feedback on that.
Well, it sounds like a lot of business practice kind of questions, and with regard to the private equity, if we're seeing if we're conducting a search for OCIOs, we're going to look at the different quotations about what the different products are, and of course we know that the private equity position doesn't necessarily require a lot of day-to-day monitoring and trading, right? So we'll look at the different fee schedules and realize that the fees that they're quoting on are really net of that position partially, but as Susan points out, if you're trading out of those positions, the OCIO is doing a lot of work. So that's kind of a consideration for that as well. And I think the bigger question is, are they actually doing work with regard to the private equity on behalf of the client? Because that's really where the work is. If they're just sitting on that position, and they're not going to touch it because that decision was made and they have no intention of trading out of it, that reflects on what the level of fees and dedication are on part of the OCI with regard to the privates, and that should generally cause a lower fee structure. And then you had 2 other questions, and that's a proper point for me to pass on to the rest of the panel.
So I think to answer your question, I think a better example would be, this is the first question, and I've already forgotten the second 2, but we'll have to come back. So that's good. So it's sort of, the point is, if we have a select list of managers, let's say, and that we will only, if somebody comes to us with a manager that we don't know, say for argument's sake, and you said it was private equity, but I'll use any manager, what we'll do is we'll underwrite whether or not we want to keep that manager or not. So, and then if we decide that we're going to keep that manager, even though we didn't put it into the program, we are now underwriting it and saying that's part of our track record now. So that's why we would charge fees on that. If it's a private equity fund that we didn't do anything with, there's nothing for us to do, and then we've basically determined that we can't get out of it, then that's not going to be part of our fee. If we do find that we can get out of it, and through the secondary market, those assets are going to come back to us, and then we're going to redeploy those assets, and so then we would charge on that. Does that make sense for point 1? And you're going to have to remind me of the other questions.
Performance fee on the discretionary alternative would be a different fee
No, it's just a flat. It's just so it's an incremental, as I described, a fee schedule that's just a little bit higher when it includes alternatives. But no, they don't want to pay fees on top of fees on top of fees.
No, we don't charge performance fees on top of it for OCIO, but if you hire us for a niche strategy that's very specific, then we will get a performance fee on that, but it will be on the alpha.
Yes, we'll only charge fees on what we have discretion for, but we want discretion of all of the assets. If there's something that they can't get out of, then as the other panel said, they can't get out of private equity, then we're not going to charge a fee on it. So we only charge a fee in which we have discretion. Typically, that's most or if not all of the portfolio. We don't have performance-based fees. I talked about we didn't have alternatives. We do have some liquid alt strategies, but so that's just a straight. There's no performance fee in there. And then I think, is that the two questions, or there's a third? Yeah, so we haven't come really. Right. And
how do you manage that? Well, exiting private equity is pretty impossible anyway. Well, so for instance,
exiting liquidity constrained sub-assets.
Right.
However you want to.
So go ahead. No, I was just going to say we typically don't take that on. That would be up for that staff to wind that down or see it through. But in our case, we wouldn't even take on that responsibility.
We would look at it and look. You're hired. If you're hired as the OCIO, you're going to be fair to your client. I think everyone here is going to you're going to say, look, I got to actually manage this underlying private equity position because whether you like it or not, it's in these 3 energy companies, and I'd rather put a hedge on it than just watch it deteriorate, right? And then you may just do that overlay, and then you do want to be paid that as an AUM, right? So it depends on what it is you're inheriting, and you discuss it, I think, with the board and make a decision. Like that's what I would do in that case. But it really depends on the client. It depends on what you're inheriting. It depends. We do bespoke portfolios. We have very specific clients. So for us, it's more of a collaborative approach. But generally, we try to do what we think is fair.
There's a lot of trading in private equity these days, and there's an implicit market price of liquidity that is very low at this point in time. It could be really high at other points, so you can't necessarily count on the ability of the OCIO to do it, say, in the year 2019. But right now, most of the things are very tradable, and of course, it requires the consent of the managers.
Just a question about institutional investors that need to match assets with liabilities. And I guess CIO deals with the asset size of a balance sheet. And is there a danger to make those two functions too far removed that it poses a sort of investment return risk for the institution? And are there steps institutional investors can take to try to make sure those two functions integrate better and don't leave money on the table?
So go ahead.
So I guess, one of the things that what we work with our discretionary clients very closely on is making sure that the liquidity needs that they have and what our asset allocation might be is a good fit. So we don't do the asset allocation in isolation. So that's something that we would typically do more on an advisory basis to come up with whatever the asset allocation is appropriate for that particular client, especially on the DB side, because that's such an incredibly important part of the risk profile of a particular defined benefit plan. And then once there's agreement on how much illiquidity that they're willing to take, what their cash flow needs are, and so we have a number of clients that are de-risking, and they are not allocating any more incremental dollars to illiquid assets because they're more on the de-risking path. And then we have others that have very long durations who have a very long horizon, and they would have much more allocation, much greater allocation to illiquid assets. So that's kind of how we balance those.
Great panel. Have a fundamental question regarding the use of alternatives. You talk about getting paid an advisory fee, and obviously on the total, and so you've got to fit in all those exposures underneath underneath that budget of to make it work from your standpoint. And even though alternatives fees have come down a bit, they're still so much higher than what you're paying for beta, more mainstream beta. So, for only 10 or 20% or maybe 30% total of an endowment's allocation that would be in alternatives, how do you balance that out? I mean, you end up with a universe of particularly low-fee hedge funds to sort of make that balance out so your overall number hits. And Brian mentioned using liquid alts, as a way, but even liquid alts funds are relatively expensive in there. So this was sort of my first question, and the second one was going to be from the standpoint of particularly hedge funds today, where obviously haven't been getting good press for 2 or 3 years, their use in institutional portfolios. But sort of where do you all individually, where do you see them fitting in, in today's environment and going forward? Where is there still a use for things that you can really only get in a hedge fund structure?
We're doing a lot of hedge funds in the private credit space, and most of them have a preferred return bogey they have to meet. So you're paying a fee of 1, and then you get the first 8% without a performance fee. And that's almost as good as anything out there. All right. Secondly, I'm sure both these guys know you're setting up a managed account on the long-only side. That's very reasonable, both on equity and on fixed income. And right away, that's 30% of your portfolio at less than a point easily, right? So then you can counterbalance that maybe with somebody who's more of a niche private equity or venture capital player in it. And there we're doing more and more in terms of negotiating payouts that, they don't take their money out for 3 years and the carry goes forward. So I think everyone is listening to getting the right kind of trade-off between return and payout. I just see people much more willing to negotiate on fees and concessions across the board on all of even you were just at Carlisle on Monday at their conference, and their fees for both the 2 new funds they're raising are going to have a pref in them. So, everyone is understanding that since the absolute return is coming down, they got to break the return up a bit more.
I'd say with respect to hedge funds and where they fit, I mean, we've never been huge users of hedge funds. I think they have a role and a place, and I think and again, I would say I would put private credit a little bit different. I mean, those are I'm just talking about traditional hedge funds, and the places that we've used those are really to decrease risk as opposed to return seeking, because there's a lot of hedge fund strategies that I would say are diversifying. I think you guys have a diversifying bucket, and we would use those as diversifying. Long short equity would be something where somebody is looking to, they've already taken down their equity allocation and they're worried about downside risk, and that's kind of the primary concern. You can do that a number of different ways. You can buy low vol, you can buy hedge funds. It's really somewhat of a client preference. So those are the kind of the places where hedge funds, where we have used them, is diversifying and risk mitigators, as opposed to necessarily the panacea of return expectations. I would say with respect to private credit, that's where we've been spending the bulk of our time, whether it be more traditional credit type of strategies or really more off-the-run type of credit, where we think there's some dislocation in some of those markets, not clearly enough in my view, because it's very, very hard to find 8% return things. But those are the types of things, if you have a return bogey, alternatives can play an important part, and you absolutely have to balance the illiquidity versus what the returns might be.
And so lastly, I'll just opine quickly. We don't, this is probably another panel, but We don't see hedge funds as a separate asset class, right? They're typically investing in some part of the equity or fixed income markets, and so we don't see it as a separate asset class. And then would you agree with Roger in the sense that we see it as a diversifier, a way to mitigate or bring down your risk? So you can do that through the alternative strategies like a global mid-vol or a long-short portfolio, and a lot of that you can do quantitatively, and you can do it quantitatively cheaper. So that would be our argument. Like I said, we could have a longer discussion on it, but we don't see hedge funds as a separate asset class, and therefore that's why we don't invest our client portfolios in them, with the exception of those some clients want some risk mitigator, and we can do some liquid alts because we think having that liquidity and at a lower cost always makes a difference.
I guess I'll just add, and I'll add a point on hedge funds. I'm seeing increased fragmentation of investors' views of hedge funds that a lot of them aren't thinking about, okay, do I want hedge fund allocation? They look at, well, there's some sub-strategies that would formerly or currently be called hedge funds that they like, whether it's distressed or event-driven or emerging market or commodities, and that often the thinking is about, well, what's my asset allocation supposed to look like, and how do I best get that? And frankly, a hedge fund, when they come right down to it, is a legal vehicle. Yeah. So there's a lot of room in there. So Rusty, you had a question with the microphone?
Yes, I did. I was going to mention that this is a very informative panel, and I thank you all for giving me some ideas too, frankly, that we didn't have. Because at IMI, we've been teaching our endowment and foundation clients for over 20 years on OCIO. Some of you might have attended, I know. I also want to say that we're finding that OCIO is really a life-changing decision. And it's really not for everyone. Some are going to want to keep the consultant model. And as Chris pointed out a moment ago, we even have some clients. One client, for example, is $8 billion and was without an OCIO firm and just decided to come back and bring it back in, but they're doing it by building a staff. IMI, just for all of you here too, there's not a lot of information on OCIO providers. And we have decided 3 months ago, because we have quite a list of who they are, to put on our website, it's completely free, by the way, an OCIO exchange, if you want to go up on it and take a look. It's who's up there, what they're doing. I mean, firms like Willis Towers Watson, Mercer, Veris, BlackRock, JP Morgan, Vanguard, you're all up there. But it gives you a little insight into the growth of it. We have noticed that in our research, because we do a lot, that the OCIO model is not going to go away. And more importantly, it's close to $2 trillion right now from the research that we're doing. So just to give you a little feel. I was also going to mention that next month right here in Stamford, we're going to be hosting an OCIO summit. And if you want to see it, you can take a look at it on our website also. It's investmentmanagementinstitute.com. There's many OCIO providers on it. There are a lot of institutions on it. So, and hopefully we're addressing the issues that many of you might want to know if you're with an institution trying to decide to speak to someone earlier tonight that here in Connecticut that I think would, might find this valuable. The last thing I wanted to mention, though, we've been talking about institutions. I'd like to ask you, well, let me first of all share with you. Chris and I just made an agreement with a firm here that wants us to help them on their governance, especially issues. These are families, and these families are all in China. And China is becoming very large. For those of you who are CFAs, I was blessed to speak at the CFA 70th anniversary dinner a couple of months ago in New York, and I was one of 5 speakers there. One of the speakers was the current president of the CFA Institute from Hong Kong. And when I was there, I left and started IMI in 1981. We had a little less than 35,000 CFAs. Today, there are over 180,000 CFAs around the globe. Back in 1981, they were all in the U.S., Canada, and a little bit in Japan and Europe. What was astonishing to me, and I think most of the people in the room, when it was shared that there are 250,000 people taking the exam this year, considering there are 180,000 globally right now, and 42% of those taking the exam are from China. So it might be just something you all kind of know, and maybe I didn't know it myself, but it was very informative. But I would be curious, and I don't know if you spend much time with families, but we are working with families right now. And you might, if you have any information on it, might like to comment on it, but I see it as a big market here. And I didn't realize how perhaps it could be overseas. Whatever your thoughts are, you're welcome. And thank you for a wonderful evening.
We do have a couple family offices as OCIO clients. So.
We do as well. In fact, we have been growing in the Middle East, where the needs there are yet even more different than some of the needs we found in Asia, because they have the Sharia law, so you have other considerations in the allocations to take into account.
We are not working with any family offices right now. We do have a dedicated high net worth group, for individuals with over $1 million. But we're not working with family offices right now. And then with respect to international, yes, we just opened an office in China because of the growth there. So, yeah. So
are you beating us there?
International is going to be increasingly important, to us, but I think to everyone, of course, right?
We've time for one more question. It's right over here.
There's a couple of simplistic questions. Just trying to connect things I heard. Early on, there was discussion that a lot of the in-house institutions, endowments and such, don't have the in-house talent, and so the OCIO model is kicking in to help. But I see two firms at the table that are very much involved in execution and building and constructing portfolios. And, but then again, that's not really an outsource of an institution's investment talent. So I'm trying to draw the lines between like a fund of funds where you're actually taking over their investing activities versus actually executing on construction and maintaining their portfolio. The lines got a little gray for me. Maybe I'm the only one in the room that happened to. The other thing, too, with the movement towards passive investing or beta, and I know we've heard tonight that alpha is about ready to come on strong, but I'm just wondering, has that been a headwind to the growth of this OCIO? I mean, because I think a lot of your value add is going to be on the alpha gaining side, the alternative investments, because there's a lot of places to get beta. So I know that's more than one question, but I'm just wondering, what's the biggest thing is the boundary between essentially taking on all their, performing both an asset management as well as a consultant role, or you just still consultants, you're just another layer.
Well, I think the critical distinction for an OCIO versus a consultant is that the OCIO has the discretion. So they have the mandate. And if you think about it from a fiduciary perspective, it's a huge leap. Right. Because the institution now doesn't have 20 managers. They sort of have 20 managers. They really have one manager who decides everything. And they've got to get it right. It's a life-changing decision. And that one manager, as long as they have the mandate, can then manage to allocate the 20 or 50 sub-managers or more. So that's the critical distinction between a consultant and an OCIO firm.
But they're not trading then. In other words, you're not
No,
trading on their behalf?
Well, they could, but usually
Good. You can do whatever you think is the right thing to do for the portfolio and whatever you're hired to do. So yes, we do option overlays to hedge. We, if we wanted to set up a managed account of bonds and then set it up to be a certain duration to capture different factors, we could do that. It's up to us, but it's not a very optimal use of my time to be doing that. I would rather hire someone who I think I want to hire the best manager for each asset allocation slot I can. And because I'm an OCIO, I am not the best manager out there.
But the scope of coverage that each ICIO firm chooses to do may very well vary by firm based on their capability.
Absolutely.
Okay.
That's right.
I mean, if you were really big,
That's Chris's job. Chris has to figure that out.
Yeah, but I'll just expound on that a little bit because we focus a lot on it's outsourced CIO, which is OCIO, and that they really come from, I kind of describe it as 4 different directions. The most common one that we see these days is the consultant becoming discretionary and thus an OCIO. But they also come from other directions. Susan has run a very successful alternative investment firm, which is a specialized manager having an in-house fund of funds and other products. So that's a product specialist who then expands and becomes an OCIO firm. Other directions we see coming into the OCIO market are private wealth managers or private bankers taking basically they've already been OCIO firms, they just haven't called themselves that, and then extending that to running money for endowments and foundations. By the way, check mark, that's an area you want to be very careful. It's not that not every team there is going to have a problem, but there's a tremendous amount of conflicts of interest in the private banking market. And then the 4th area is teams that used to run endowments and foundations stepping out on their own and saying, we don't need to do this just for one endowment foundation, we'll do it for many, and that's another area. So those are really the main 4.
Yeah.
And that last one is really how it all got started with Stamford and the other endowments outsourcing. So that's a great way to conclude. We've kind of brought it all back to the beginning. So thank you all for coming, and please stay for drinks.